Is going to take a long time, and many of those jobs are simply not going to come back. I think the shock that we've experienced now is more fundamental than what we had after 9/11, more fundamental than what we had after the global financial crisis. Some of the industries are simply not going to come back, and some of those jobs are not going to come back. So it's going to take a long time to make the transition.
Has rallied hard from those March lows. The Nasdaq almost back towards those peak levels, 40% up from the lows for the S&P 500. And this is very much playing this Fed put theme that the central bank will step in. Are they putting too much faith in the actions of the central bank?
There's only so much that the central bank can do. Central banks are extremely powerful. As a former central banker, I'm never going to say that central banks aren't powerful, but they can't cure the virus. They can't unlock economies. They can't replace broken supply chains. The central banks can help to try to prevent a financial crisis. They can try to provide support as a bridge to a new equilibrium. But it's going to be a while to get to the new equilibrium, and it's not going to be easy.
Randy, good morning to you, sir. The new equilibrium was promised in 2016 by the Republican nominee for the presidency. He promised to outspend Hillary Clinton by at least double her promises of $500 million, including loan guarantees. He promised at least $1 trillion, and he's been doing it again more recently as well. Isn't this, and we need to call this, an ignominious failure of the government to spend the money they promised to do so over the last 4 years on infrastructure build in the US? We still have vague promises, but the chances of it coming through are very slim, aren't they, sir?
Well, I don't think this situation now is about infrastructure spending. I really think it's, it was an inability to have the data to understand how to have a focused response to the virus to make sure that we could protect both lives and livelihoods. Now, that means that there's an opportunity for infrastructure spending going forward, and I think that's likely to be the next step in the responses, both in the U.S. and globally.
But, sir, the New Deal came about from, you know far better than I do, from 1933 onwards in response to the crisis that started in the late 20s as well. And it came through with meaningful contributions on the infrastructure. We did protect those lives in the economy that you were talking about there. I see no sign of any support, cross-party or indeed coming from the administration, for longer-term spending plans to create that kind of 21st century New Deal. If you can see it where I can't see it, please tell me where, sir.
Well, certainly there's been discussions in the past about doing more infrastructure spending, and I think you're right, both in the U.S. and around the world. The focus has been much more on the short term, because I think there's been a hope that you'd have a sharp down and a sharp back up. I think it's going to be, at least in my opinion, I think it's very difficult to see the sharp back up. We've certainly seen the sharp down, and I do think we're going to need to see spending that will be focused on the longer term transition, where you're retraining people, where you may be building new types of infrastructure, because of course people may not be going into central cities as they once were. So it may be new types of infrastructure that would be needed rather than the ones that were talked about a few years ago.
I want to ask you about the default outlook in the United States. Clearly, the short-term support measures have helped keep businesses afloat in a fairly indiscriminate way. But as we come out of lockdown and businesses reassess the demand outlook and potentially look to resize, what does that mean for default rates in the U.S.?
I think you're going to see a significant rise in firms just being unable to pay the existing debt, even if some of that is forgiven, like in some of those loans. There's going to need to be a lot of debt renegotiation, a lot of restructuring if you want to try to preserve as many jobs and as many businesses as possible. So I think having an expedited approach to that would be valuable. There's going to be a lot of discussion of across-the-board debt forgiveness. And actually, going back to the 1930s, we did do a widespread debt forgiveness then that actually worked fairly well. In some countries, they tried to do that, like Argentina, elsewhere. It doesn't work very well. It has to be very, very clearly worked out, very clearly consistent with legal structures. But I think we're going to be facing a significant number of bankruptcies over the next year to 2 years.
And what about those companies that are actually in decent shape but are just hesitant about what the future looks like? What are you thinking about business investment in the coming quarters and even in the coming years?
Yeah, I think certainly over the short to intermediate term, you're going to see a lot of wariness on the part of businesses to invest. There may be a few, like in the tech world, that will certainly be doing investment because they are doing well, but that's a small fraction of overall investment. You're probably going to see a lot less investment in the energy industry, for example, with energy prices so much lower. In traditional commercial real estate, you're probably going to see a lot less. So many of the areas where there's a lot of investment, you're going to be seeing less. And in general, I think firms are going to be pretty wary until they see how consumers are going to act, how they see how policy is going to be. I mean, this is very different than after 9/11, which was an enormous shock to people. But we got the airline industry working again. We got people back onto airlines. People felt safe to go out. And that's very different than now, where people are still very wary. Even if people are allowed to go out, they still may not consume.
Randy, still much debate on the will they or won't they go negative on rates discussion. And this week, the St. Louis Fed economist released a paper effectively arguing that to get a V-shaped bounce in the economy, negative rates are necessary. What do you think?
Well, I'm not so sure there's really that much that the Fed can do to make sure that we get the V-shape. I think the Fed really does not want to go negative, and they really would prefer not to. And I think if they can get enough of the resources out now, and that's what they're trying to do, the balance sheet has exploded even far beyond when I was there a decade ago. They're trying to make sure that they don't get into that situation. They want to avoid deflation. But if they get into a deflation situation, I think they will have to reevaluate and then consider negative rates. Because if they keep rates at zero and the price level is falling by 2 or 3%, that means that real interest rates, that is inflation-adjusted rates, would be relatively high at 2 or 3%. And so they would then have to consider that. But they're going to do everything they can to try to avoid getting into that deflation situation, which would force them to consider negative rates.